And this could seriously affect global markets harder than people expect, because for years or decades, interest rates were kept near zero. And all of the money, whether it be Japanese pension funds or traders around the globe, would borrow, for example, yen at near zero, and then use the excess or use that free money to buy things like U.S. government bonds. And so there's over $1 trillion worth of these bonds that are owned by the Japanese pensions that are now, when you factor in the carrying costs and a rising yen and higher rates, these bonds are now basically underwater and they have to liquidate, and that's what they're doing. This kept the yen weak. It kept the dollar strong. It kept money flowing around the world, but it also is now coming home to roost, where these higher yields that you're seeing in Japan, along with inflation rising in Japan.
Something big just broke in the global markets, and very few people truly understand the scale of what's happening. In the last 30 days, the Japanese yen has surged more than analysts expected, forcing Japan's central bank to intervene while raising rates at the same time. That alone should have been a flashing red warning. But behind the scenes, something even more dangerous started happening. Japanese pension funds, insurers, and global macro funds began dumping U.S. Treasuries at the fastest pace since 2012. That matters because these institutions hold over $1 trillion in U.S. bonds, many of which are now underwater as rates rise. And once they start unwinding the yen carry trade, the same strategy that fueled global liquidity for decades, it triggers forced selling across everything from treasuries to tech stocks to currency derivatives. And we're seeing the early signs: U.S. bond auctions showing cracks, repo liquidity tightening, and volatility returning to markets that were calm for years. At the same time, the precious metals markets are showing major stress. COMEX gold inventories just fell under 17 million ounces, the lowest in years, and registered silver is hovering around 29 million ounces, while December delivery demand exceeded 36 million ounces. Silver lease rates touched 19%, and physical premiums in Asia and the Middle East are climbing again. This is exactly what Andy Schectman has warned about. When trust in the bond market breaks and liquidity thins out, the system suddenly snaps toward real assets. Big money is already positioning, insiders continue selling equities every week, and central banks are quietly buying record amounts of gold. Today we're breaking down how Japan just triggered what could become the largest global margin call in modern financial history, and why gold and silver investors need to understand this moment clearly.
They're under pressure to raise rates, and they're doing it, and that'll make the yen more expensive to borrow, which makes those already unprofitable carry trades even more unprofitable. And I think these funds and investors are now unwinding their positions. They're selling their bond holdings, and they're bringing everything back to Japan, which is going to put massive pressure on the bonds in existence and the currencies around the world, because it's been a piggy bank to the world where you could borrow at nothing and buy NVIDIA, Bitcoin, treasuries, anything. And that has been, Japan needs to bring back this money to support its own economy. And it's going to start doing it by selling bonds. And the question is, how quickly will it unwind? Will it send the dollar crashing? Will it send rates spiking? And when you realize, again, going back to that same thing about trust, that the whole U.S., the whole system is already under pressure. I think this has the potential to trigger massive financial problems if the unwinding of the carry trade is anything other than orderly. And rates are going higher in Japan would be my belief. Yeah, I mean, you mentioned a deflationary spiral, but what about inflation you're talking about? You measure any asset you can think of in terms of ounces of gold over the last 50 years, and prices are falling against gold, against the real measuring stick. Against the dollar, they're going the other direction, and it's that the dollar is falling too. And so it's a situation where you're right. Anytime you suppress interest rates, I think that's the issue that got the whole world into problems. You suppress interest rates, and that creates distortions and all of the asset prices that have never been allowed to find real price discovery. And it tells me that the assets that have been pushed higher, when real price discovery comes into picture, in an environment of higher interest rates, it will be a religious experience for a lot of people. And at the same time, those assets that have been held down, conversely, like precious metals, it'll move in the other direction exponentially when they are free, not only from manipulation, as we're seeing the problems on COMEX and the LBMA. You manipulate prices for too long, the physical demand will put you out of business. It will bankrupt you. And I think the big money understands that. And on the other side, maybe this is why you see Buffett in 400 billion in cash, and why you see all the insiders selling every single week, 2 billion a week for the last, I don't know how long, and Bezos and Zuckerberg and all of these people selling. Maybe that's why, because they know what's coming. When price discovery really truly is allowed to manifest itself in a world where money isn't free anymore, and the ramifications of it start to profoundly expand, very quickly, I think not only will you see those assets that are ridiculously priced start to deflate, but you will also see those that have been suppressed move much higher, as there are very few safe places left yet to go. And maybe that's why we're seeing these massive deliveries. The people at that level of wealth and sophistication don't do it just for the hell of it. They know what's coming. They're 2 or 3 steps ahead of everybody. That's why I would say do what they say, don't do what, or do what they do, rather, don't do what they are saying. But it takes so much effort to figure that out that if you're not researching the way you and I do every day, you won't even see it. And it will just be one of these things you'll wake up one morning and say, my God, can you believe how high gold and silver have gotten? In fact, I got one today. I got a text from my buddy, Steve. I call him Flip. And he says to me, I just saw the silver prices today. Wow. How high do you think it's going to go? I should have bought when you told me to at 22. Well, that's exactly what you're going to see happen. I think it's going to go much, much higher, and people will just wake up to a new reality, and at that point, the big money will have already been long since positioned. Well, I mean, I think it's all intertwined, because Bo Hines, who was Trump's crypto advisor until August, is now the CEO of USA Tether, which is already Genius compliant and will get the lion's share of all the stablecoin issuance backed by U.S. Treasuries, which, to your point, gives synthetic demand for the Treasury. But the interest on those coins is not transferable. If you buy something and the stablecoin is created backed by treasuries, you spend it, the stablecoin gets burned, it's done. But the interest that was generated on the treasury is not transferable to the holder of the stablecoin. It has to be kept by Tether, who then is buying gold. They have almost 13 billion in gold. They were just at the Beaver Creek Mining Summit. So there's a lot to say about the stablecoin in terms of the ultimate benefit to the gold holder, which devalues the dollar, which we've talked about. That's what they want. The debasement trade. You haven't seen mainstream talk about the debasement trade. Makes paying off your debt easier. And we've talked about how they could develop a roadmap to bring back manufacturing. That is a key part of it. The continuation synthetically of demand for the treasury market, which has lost demand and is continuing to lose demand, but that synthetic demand will then be used to take the revenue from it, drive from it, not give it back to us who hold the stable coins, but buy gold with it. And I wouldn't be surprised if there was a wink, wink, nod, nod between Trump and Tether. You're going to give us that metal. You're going to sign a contract discreetly, maybe even through this exchange stabilization fund, and you're going to sell it to us at some point. Maybe.
For decades, Japan's near-zero interest rates created a global liquidity engine. Investors borrowed yen at almost no cost and used that money to buy higher-yielding assets across the world: U.S. treasuries, tech stocks, emerging market bonds, even crypto. This kept the yen weak, propped up the dollar, and inflated global asset prices. But now, inflation inside Japan is forcing the Bank of Japan to raise rates. A stronger yen means every dollar borrowed becomes more expensive to repay. And with global yields much higher, the very bonds these investors bought, especially treasuries, have lost a huge amount of value. This is why Japan is selling U.S. debt aggressively. Pension funds and insurers can't hold underwater bonds while their currency strengthens. They must unwind, and fast. Once that unwind accelerates, global markets feel the pressure. U.S. yields jump, liquidity thins, and risk assets start selling off. This is the foundation of what Andy Schectman calls the biggest margin call in modern history. The entire financial system was built on cheap money. When that reverses, everything built on top of it begins to slide. And while financial markets face deflationary pressure, the precious metals markets are showing the opposite, tightening supply and surging physical demand. COMEX and LBMA inventories have fallen steadily. Spot prices in Shanghai are trading higher than Western futures, signaling shortage. Massive deliveries for gold and silver continue, far bigger than what paper markets can comfortably support. This mismatch is pushing futures into backwardation, something Andy has warned about for years. Physical demand eventually destroys manipulation. Meanwhile, stablecoin issuers like Tether are buying gold with the interest they earn from treasuries, nearly $13 billion so far. Central banks bought over 42 tons of gold last month alone. China continues to import through back channels, and insiders, CEOs, founders, billionaire investors are selling U.S. equities at over $2 billion per week. Andy's message is consistent. Big money is positioning itself ahead of the storm while average people remain distracted. As Japan repatriates capital, global liquidity shrinks. Overpriced assets fall back to reality, but hard assets, especially gold and silver, finally break free from years of suppression. This is why Andy says physical metal is the last form of wealth outside the digital surveillance system being built through stablecoins, digital IDs, AML/KYC tracking, and central bank coordination. When real price discovery returns, precious metals don't just rise, they reset.
But anyways, I digress. When you talk about what it could have in store for you, yeah, they have AML, KYC, and KYT compliant technology built into the software. Know your client, KYC, AML, anti-money laundering, KYT, know your transaction. They will know who you are, where your money came from, and what you're buying. And you're right, it is a central bank digital currency masquerading as a stablecoin. The big difference is that instead of, it's the CB, there's no central bank. These are independent third-party companies. But isn't it interesting that Trump's crypto czar is now the CEO of this new division that is going to issue the USA Tether tokens? Interesting how that plays out. It's just as interesting as Goldman Sachs saying if the Fed loses independence and the market gets whiff of it, gold will go to the moon. Well, who just took the vacated spot? Stephen Mirren, the head or the gentleman who wrote the Mar-a-Lago Accord, Trump's advisor. These things are not by mistake or by accident, they're by design. And so, to your point, yes, it will have, I believe, all of the characteristics of a central bank digital currency only issued by a third-party entity, that the feds will control the on-ramp and the off-ramp. And so it's the same thing in essence. And I think people should be concerned about it for sure, but it is here and it is going to happen. It is the only way that they will achieve, I think, what they're trying to do through devaluation of the dollar and keeping interest rates low synthetically on both cases. And that devaluation of the dollar will be through the continued increasing purchases of gold and silver with the proceeds behind those stablecoins that are backed by treasuries. The interest on those treasuries not transferable. It's a huge deal. But to the average person, yeah, I think you are just as surveilled as if it were a central bank digital currency for sure. Same way that, well, similar. In Texas, they're kind of leading the charge on this. The idea is you take your American-made coins, you deliver them to a state-run depository. I don't know if it'll be the Texas Bullion Depository or someone different, but in essence, they will give you like a credit card or an app on your phone that you can then make purchases using it in a digital framework. I think the idea of going to a shopkeeper with Gold Eagle is probably not going to happen, but using those coins, which most of the laws specifically say American made, not all of them, but a lot of them do, held in a vault that you can then keep your purchasing power safe from the continued fall of the dollar in terms of its valuation, down 100% against silver this year, pretty damn well near it after today's run, and 70 plus on gold. Forget about the dollar index that says it's only down 7 or 8%. It's down 15 times that just about in terms of silver and 12, 13 times in gold. And so you end up with a situation where you can use money, but it is done in a digital ecosystem, would be my guess. And maybe it's something like we saw recently in Italy where, desperate governments do desperate things. They're saying, tax now or later, any gold, jewelry, or coins or bars that people have not declared in terms of, or there's, that no one knows about it, you can tell the Italian government now and pay your taxes now. Who knows what they do? Desperate governments do desperate things. I just think that you have to prepare the best you can, hope for the best, and be prepared for it not to work out that way. And what other choice do we have? I'd rather have options when others have none. But yeah, it is something certainly worth considering. And at that point, the United States loses all credibility as far as I'm concerned, if that ever happened. But look, they are forcing us into this digital surveillance state. Starts with the digital ID. Well, Trump already said that's what he wants, or passed that law for voting integrity, right? What is it? And again, I always butcher these, but Ben Franklin said something to the extent when you give up a freedom in the name of safety, you never get it back, right? Well, that's the freedom we're giving up because of the election integrity. You have to have a digital ID. That's the foray into the surveillance state. The next is the money. No, it's not a central bank digital currency. It's run by third-party entities. Oh, well, then we're safe, right? And you can see how we are quietly dropping the frog into the pot of lukewarm water and slowly turning up the heat. What it appears to me is that is where we are going, and you do the best you can to stay out of it. And everything that you're doing is legal. You got that on your side, and you hope for the best. It's a very small percentage of people that will have that ability. Maybe it's not worth it to rattle the bushes because most people wouldn't know a gold coin if it fell on their big toe.
What we're watching right now is not just another market correction. It's the reversal of a decades-long global cycle. Japan's unwind is tightening global liquidity. U.S. Treasuries are losing foreign buyers. Stablecoins are absorbing interest to buy gold. COMEX inventories continue to fall. And central banks are preparing quietly while insiders get out of their stock positions. This is exactly the kind of moment that only makes sense after it happens. But gold and silver investors who understand the signals, the carry trade unwind, the physical shortages, the massive deliveries, the rising premiums, are already ahead of the curve. That's Andy's core message. Don't wait until the headlines catch up. By then, the real opportunity will already be gone. Today's question for you: do you believe Japan's unwind is the spark that finally exposes the fragility of the global financial system? Or do you think central banks will step in again to keep the illusion going a little longer? My short answer: central banks may try to slow the fallout, but they can't stop structural forces. Rising Japanese yields and the collapse of cheap liquidity are fundamental shifts. Once the carry trade breaks, it triggers real price discovery. And historically, that leads to a major revaluation of gold and silver. If you want more powerful, data-driven breakdowns like this, make sure you're subscribed, because the next few months may move faster than anyone expects, and you'll want every advantage you can get.